What's driving markets? Welcome to Market Take. Each week, we'll bring you our insights on the latest market and economic trends that are impacting investments. I'm your host, Natalie Gill, Portfolio Strategist at the BlackRock Investment Institute. This week, I'll discuss why we stay overweight US equities even as recession fears have fueled stock market volatility. We see the recession fears driving recent stock market volatility as overdone. Yet we could see more flare-ups ahead of the US presidential election and diversify our exposure within US equities. Growth fears and investor concerns about tech's heavy capital spending on artificial intelligence are behind recent bouts of market volatility. We think this could keep driving markets with the US election in sight. US corporate earnings have proven resilient even as volatility has spiked. All sectors beat market expectations for Q2 earnings. Analysts are forecasting broad-based earnings growth over the next 12 months. We expect tech's leadership on earnings to persist, yet a narrowing gap in growth between US tech companies and the rest of the market suggests US equity returns can broaden. We favour high-quality names that deliver consistent earnings growth and free cash flow in case volatility persists. US earnings growth broadening beyond early AI beneficiaries is a sign the economy is more resilient than markets are pricing. We view extreme market reactions to weaker economic data as overdone. Growth is moderating, as widely expected. The unemployment rate has ticked up, but that's not because demand for workers has fallen. Rather, higher immigration is expanding the labour supply. Over the medium term, we see a shrinking workforce, a persistently large US fiscal deficit, and other structural shifts adding to inflation pressures. Higher inflation over the medium term will force the Fed to keep policy rates higher for longer, in our view. Here's our market take. We get selective in AI as investors question big spending on the AI build-out by top tech companies. We turn to energy and utilities companies providing key inputs for the AI build-out, as well as real estate and materials names tied to the infrastructure build. We also go underweight short-term US Treasuries as markets price in many more Federal Reserve rate cuts than we expect. Outside the US, we pare back our Japanese equity overweight. A stronger yen could drag on corporate earnings, and the Bank of Japan is sending mixed policy signals. For details, read our weekly market commentary. Go to www.blackrock.com/weekly-commentary. Thank you for tuning in. If you've enjoyed this episode, subscribe to our Market Take wherever you get your podcasts.
This material is intended for informational purposes only and does not constitute investment advice, a recommendation, or an offer or solicitation to purchase or sell any securities, funds, or strategies to any person in any jurisdiction in which an offer, solicitation, purchase, or sale would be unlawful under the securities laws of such jurisdiction. The opinions expressed are as of the date of publication and are subject to change without notice. Reliance upon information in this material is at the sole discretion of the listener. Investing involves risks. BlackRock does and may seek to do business with companies covered in this podcast. As a result, listeners should be aware that the firm may have a conflict of interest that could affect the objectivity of this podcast. For more information, visit blackrock.com